Thank you all for joining this small introductory workshop about bookkeeping and accounting by me. My name is Xander Siebers. I am one of the creative assistant accountants at de Wert 1959, de Wert Accountants and Belastingadviseurs in Eindhoven. And my main focus is helping startups getting up and running and being their financial conscious at the end of the day. So that is what I do. And de Wert 1959 is our Twitter hashtag where you can find our company. In my spare time I also teach about productivity using a free tool called Evernote, and at night time I change into the tie guy, which is stropdasserman in Dutch, because I love wearing ties in all different shapes and colors. I have about 200,000 different options for that, and I think all men must wear ties.
Sorry.
You can find me on almost any social media platform. Just look for Xander Siebers and I'm probably there. De Wert Accountants has been around since 1959. I have 30 colleagues and we specialize in accountancy, tax, HR advice, payrolling, administrative services. We have pension advice, etc. going on. So exactly what our last line says, it doesn't matter what stage you're in, with de Wert you are sure of your business. Today's goal is to give you a summarized feeling of bookkeeping and accounting, what financial and management accounting is, handling some of the terms like assets, liabilities, revenues and income. And at the end of this session you should have a basic understanding about bookkeeping and accounting. I won't be going that far as handling real accounting itself. Okay? So, major point, why should I even keep my books, as my mother always used to say, it's for your own good. But mainly because you want an historical reference or a predictive reference. If you don't have any clue as where you are going, if you are reaching your vision, your goals as an entrepreneur, then you're actually running your business as blind as a bat. So therefore you need to have some sort of accounting or bookkeeping. At its basics, and now I'm going to handle only bookkeeping, not accounting. At its basics, bookkeeping is collecting, recording, and then processing these records. And after that, you will have all kinds of information. From bookkeeping to accounting, these are the steps which will be taken. First of all, we have our business financial transactions. Those are the simple stuff like buying things, selling things, etc. These will give you rise in your documentation. So we are going to the right. And your documentations are your invoices, your credit notes, etc. Those are entered in your prime books of entry. In the old days, this was all done by hand. Thank God we have computers now and digitized systems, so this is done automatically. After that, these entries in your prime books are summarized in your ledger accounts. And at this stage, the top part is almost done by yourself or a bookkeeper. And from the ledger accounts, you need a bookkeeper or have a basic understanding of bookkeeping and accounting to get these summarized. Your ledger accounts give information to your trial balance, and after your trial balance, we have the information to your profit and loss accounts, your profit and loss, and your balance sheets. The last part is your cash flow. Why? Because sometimes an entrepreneur says, well, my bank account sums me up an amount of money, and that doesn't seem to fit with my profit and loss. That's because the difference between your profit and loss and your balance sheet is found in your cash flow, and your cash flow states where you got your money from and where did you spend it on. And your bank account only shows you the amount of money you have on at that moment. So not where you received it from or where you are going to spend it on, or you spend it on. So again, the top part, I hope you see the red line, until about here can be done by yourself or with help of a bookkeeper. And the bottom part, you always need a bookkeeper, accountant, or have to have a basic understanding of bookkeeping. Your bookkeeping then gives you some sort of information, and your information are two ways. As I said before, you have historical and predictive reference, and these are called your financial accounting and your management accounting sheets. Financial accounting sheets are almost historical. They are defined by local law. They have a standard summarization. These are used for your tax payments, etc. The management accounting is giving you the statement over a period of time, not historical. So it's more for predictive measurements. What am I doing? Do I need to get more people working, or do I have to cut some people off? Do I need to sell more? Do I need to sell less, etc. Your financial transactions, your financial transactions, which give you your documentation, are these kinds of things like your sales, your purchases, your receipts, petty cash, and your payroll. So the reason I put in this sheet is when you are bookkeeping, you have to keep track of records. And all those records, all pieces of paper you get, all documentation you get, you have to keep somewhere. This is why most companies have some sort of documentation retention system. We at the WERT use a form of digitalization, like scanning and recognition, or we have digitalized dossiers, file forming, teruggaan. We cover those files when needed. The reason why is because if, for example, the tax department asks for an invoice, you have to be able to show them from who you got the invoice, if it is a real one, etc. When doing so, retaining those documents, there is a period of time in which you have to do that, and local law defines the period of time. And for the Netherlands, keep in mind, it's always 7 years. There are exceptions on this rule, but keep the major rule of 7 years in line. And very important in this matter is that you need to be able to have the original document. You need to be able to prove that it is the original document. When thinking in documentation, pick it broader or take it broader. Also store the quotations, the purchase orders, deliveries, invoices, of course, your sales invoices, but also things like your calendar notes. When did you go to an appointment with whom? If you are keeping track of your driven kilometers, then you have to keep track of those documents also. That was the basic part. That's bookkeeping in its essence. This part is about accounting. When you are accounting, then we have one of the most used financial statements. You have your balance sheet, and your balance sheet has been put up by the formula above: assets equals liability and equity. This is needed for your balance sheet, and your balance sheet gives you a statement of some point in time. Your balance sheet will always change. It will change when you, for example, buy a cup of coffee, when you, for example, drink that cup of coffee, and when you buy another cup of coffee. So your balance sheet is always in motion. When we handle those three words, I will start with assets. What do you think are assets?
Buildings.
Huh?
Things you own.
I heard buildings, I heard
Things you own.
things you own. Okay, keep in mind of that.
Yeah, machinery.
More. Huh?
Machinery.
Machinery. Okay. In basic terms, assets are things we would like more of, like buildings, houses, gold, cash, clothes, candy. We love assets. We want those. So, assets are things which are under control of the company and not owned by. I'm going to handle that in a short period of time, but it's under control of. So we love assets, we want more of them. On the other hand, we have liabilities. Liabilities are my obligations too. Those are very simple, I believe. You could say it's the money I owe to my father or to the tax department. I somehow have to pay it at a certain period of time. The liabilities shows me where I got my money from. So, in other words, it is possible that I borrowed some money to buy a new car. And at that point, the car is under control by me, but isn't really owned by me. The last term, equity. Who can tell me what equity is? Maybe in another term, capital. The last term, equity, is the hardest part to explain, because equity is a derived term of assets and liabilities. What happens here is assets we can point out, we can call them out, houses, buildings. Those are things we want more. Liabilities are the things we owe. I can pull out a form which states how much I owe somebody in kind of debt. Equity is derived. What happens here is I take my assets, I pull out all of the liabilities I have, and there comes my equity. The equity shows me how wealthy my company is. In other words, what also could happen is when I cannot pay my debts anymore, my assets will be sold, my liabilities, my creditors will take out everything they want from my assets, and whatever is left, I get to have in the end. So equity, it's also possible that you heard that term, capital instead of equity. It's the same thing. We tend to use different kinds of words for the same thing in the end. What we are going to do now is I'm going to try to show you the formula again with your help and prove that assets equals liability plus equity, that formula can help you making a balance sheet over and over and over again, trying to get a feeling about the business. And I have a business put up, Juan in a Million. It's formed by Juan. He's selling some things. And what will happen is I have a balance sheet, and that's why I asked you to sit in front, because the top part isn't really readable. But what it says is all amounts are in euros here at the top part. I have my assets, my liabilities, and my equity. That's the only thing it says on the top blue part. My assets are three things. I have cash. I have accounts receivable. Accounts receivable are the people who owe me money because I sold something. And I have inventory. And we all know what inventory is, I hope. Those are the goods I want to sell. Okay? On my liability side, I have accounts payable. Those are the debts I have to other people. The utilities payable are, for example, the electric company, which I owe money to when using electricity. And at the end, I have my Juan in a Million, my capital, my equity. So, let's start Juan's saga. I would like to know from you the following. Juan invests in his business 12,000 euros. What will happen? When Juan invests in his own business, the following thing happens. His cash goes up 12,000 euros. On the other hand, because it's his own money he puts in his company, his equity goes up 12,000 euros. And when you look at the formula again, assets equals liability plus equity. When we put an, where is my laser pointer here? This the red button, Peter?
Yeah.
Okay. When I put an equals sign here, you see 12,000 equals 12,000. Next question. Juan buys from somebody he knows really well 4,500 euros of inventory he doesn't have to pay immediately. What is going to happen? Very good. This is what's going to happen. It's really basic. Juan gets inventory he doesn't have to pay. Our assets go up 4,500 and our accounts payable, the people who I owe money, goes up 4,500. Okay. Next thing. Juan rents a shop for $600. What will happen? So this is where I wanted to go to. Cash goes down, minus $600. And to keep the formula in balance again, my capital goes down at this stage. I'm not handling expenses momentarily. I'm just thinking in terms of assets, liabilities, and equity. Okay, next thing. Juan makes his first sale. He is selling 2,200 euros of inventory, and he's he's selling it for 4,000 euros, and he's not getting the money up front. So we get two lines in this. I make a sale. My accounts receivable, money I didn't receive yet, somebody owes me, goes up with 4,000 euros. On the other hand, my inventory goes down with 2,200. Remember this line, this is very important. I shouldn't have said that. Okay, next question. Juan decides it took him long enough, and he wants to pay his only creditor he has, the 4,500 euros. What is going to happen? Cash goes down, 4,500 euros. Accounts payable goes down, 4,500 euros. And if you look at the right side, my formula is still in balance, right? My debtor decides to pay, and I believe he pays his 4,000 euros. No, 2,000. Sorry, I didn't read it. Yeah, partly yes. But what I wanted to have is the following. Juan goes to the mailbox, pulls out an envelope, and it says he has to pay $100 to the utility company. I read the line incorrectly, but he's going to pay the 100. So the utilities payable is going up, and its equity goes down. He didn't actually pay it at this point. In a later part, we're going to handle expenses, so I'm going to get to expenses later on. But this is what is going to happen. Now, for the last part, Juan has a really good month. He's going to celebrate, pulls out 1,000 euros out of the cash register, and goes to party. What will happen? This is what will happen. Keep in mind, though, this is a private party, not tax deductible or anything. It's just he takes 1,000 euros out of his company and goes to party. At the end of the month, when you check all columns, you will see that his cash has been dropped to 7,900 euros. His accounts receivables are 2,000 euros. His inventory has dropped to 2,300 euros. He doesn't have anything more to pay at his accounts receivable. The utility company, he still owes 100 euros. And when you look at his equity, his capital, it should be 12,100 euros. And what we do in accounting is we not only go downwards with our controlling, but we also go sideways. So we take our formula and we check if this is correct. When you take the numbers, 7,900 plus 2,200 plus 2,300 makes 12.2 equals liabilities plus equity 100 plus 12.1 makes 12.2. So the formula works in every kind of way. Keep this in mind when you're reading a balance. It should always be in balance. You can put this in a balance sheet, which shows you the numbers like this. I don't know if you have ever seen a balance sheet, but on the left side you always have your assets, on the right side you have your equity plus your liabilities, and below the total amount should be equal to each other. Oh joy, more fun, because the second big equation in accounting is revenues equals expenses plus net income. And whenever you see the word net, you have to remember that it is something minus something. Okay, so I will get back to that at this moment. You need this equation for making up your income statement, and your income statement is it gives you the reports on your result of operation. And these are things you did. This means transactions with your customers, your labor, transactions with your suppliers, the government with taxes, and like we said just now, with the utility company, for example. And you also should know that the balance sheet captures a moment in time, and your income statement gives you a period of time, gives you the revenues of a period of time. Revenues are new assets provided from delivering goods and services to someone. When I buy a cup of coffee for €5, where is the revenue? Can somebody show me where the revenue is? Tell me where the revenue is. Huh? I buy a cup of coffee, the revenue for the shop holder.
Oh, okay.
You have a coffee shop, I'm coming to you, I'm buying for €5. Where is your revenue?
Sales minus inventory.
Huh?
Sales minus inventory.
Yeah, don't go so far, but keep it simple. In the old days, we had cash registers. We put in the sum, and then we pulled on the handle. My kid still has a cash register like that, and it goes ka-ching! That's the revenue. Revenue is not something you can see. Revenue is the moment in time when your cash register makes that sound ka-ching. It's the birth of a new asset. It's when you deliver something where you get money from. So nobody's going to give you anything for free. You always have to use something to deliver something. In some cases that would be man hours, in other cases it would be a cup of coffee. Expenses, on the other hand, are the exact opposite of revenues. Those are the things you need to make that revenue. Okay, and then we have our net income, which is our revenues minus my expenses. So what we are now going to try to do is, I'm going to take the same balance sheet as before, with the same numbers, and what I would like to know from you, if something is a revenue, an expense, or is just a transaction on the balance sheet itself. Yeah? So let's start with the first one. I will give you this one for free. Juan invests in the business for €12,000. His capital goes up with €12,000. This is just a transaction on the balance sheet. There is no revenue, there are no expenses. He didn't make a transaction with anybody, he just put in money of himself in the company just to get started. So in this case, nothing will happen. So the next question will be, Juan buys the inventory, and I have to take this. Juan buys the inventory for €4,500, not paying it up front. In the last sheet we already saw that the inventory would go up with €4,500 and my accounts payable would go up with 4,500 euros. But is it an expense, or is it a revenue, or is it not part of this equation?
Nothing. Not part.
Not part of the equation. Why?
There's no money transfer.
It's just
No money changing hands.
yeah, no money changing hands. Very good. This is what happens. Nothing, no, not part of the equation. Revenues are expenses plus net income. Juan rents a shop, and he does that for 600 euros. What happens?
Does he pay? Does he not pay?
Juan rents a shop. His cash goes down. So what we saw in the last slide was his cash went down with 600 euros. His capital went down with 600 euros. But what I would like to know is it part of the equation?
Expense.
Why? Why is it an expense?
He's actually paying.
He's actually paying, but why? Paying something doesn't make it an expense.
Get something back. You get the rent back.
He cannot drive business without the shop. He needs the shop to be in business.
Yeah.
So the costs for owning or for opening the shop, these $600 are put up here as expenses. Without the shop, there is no business. You couldn't sell that cup of coffee to me without a shop. So therefore, this is part of the equation. Revenues are expenses.
But if he gives a party, it's also an expense, right?
I'm coming to that. I'm coming to that.
Okay.
We have a party at 8. Okay. Next question. Juan makes the sale on credit. Remember, he sold the goods for 4,000 euros. What happened was my accounts receivable went up for 4,000, and my inventory went down with 2,200. What will happen with those two lines? Nothing.
I think his revenues will go up with 4,000 and his expenses rise with 2,200.
And I believe that's the only correct answer. Because this will happen. What happens here is he's selling one of his assets. A revenue is the death of an asset. And he's using that to make something else, making a new asset, making money. Yeah? But what happens in measurements is my inventory only goes down with 2,200, which is my true expense. But I'm getting another measurement in return for that, 4,000 euros. And the difference between these two numbers is my gross margin. And I will show the gross margin later on. But this is the profit I'm going to make at this moment of selling those goods. Buying them for 2,200 and selling them for 4,000.
But you haven't the ka-ching.
Huh?
You haven't the ka-ching.
Yes, this is the point. I make the ka-ching.
Ah.
I did not receive the money at this moment. Receiving the money is...
Revenue is the moment you
I make the sale.
close the deal.
Yeah.
Okay.
Receiving the money or paying it, just as in the question you asked me just now, isn't the point. It's the point of when you make the transaction itself. I have another one which was the paying of the creditor. Remember, he pays his creditor 4,500 euros. What will happen? My accounts payable went down with 4,500 euros, and my I believe my cash went down with 4,500 euros. Is this a revenue or an expense?
Expense. Yeah, expense then. Oh, wait a minute, he pays yeah, it's an expense, but
It's not an expense.
because yeah, okay. Now he pays the invoice that he got earlier.
Yeah.
Yeah, okay. So the expense has been made already. It's
There-
basically,
but there was no expense here.
yeah.
You would say I have an expense here, but it's turning cash into an inventory, and later on I'm paying.
It's just a balance sheet transaction.
Yeah, it's just a balance sheet transaction, not part of the equation. Revenues are expenses, plus net income. I believe I have one more, which was the collection. His accounts payable. His account payable delivers him or pays him 2,000 euros of the 4,000 he owes. So I'm getting 2,000 of that amount. What happens on my balance sheet? I will help you. My accounts receivable will drop with 2,000. My cash will go up with 2,000. But is it part of the equation, or is it just a transaction on the balance sheet?
Transaction.
What?
A transaction on the balance sheet.
Yes. Why?
Because it doesn't have to come with an expense or an income.
Why?
It's already done.
Because there was a push and save before and now
Yes.
something in
Very good. That's very, very. Sometimes that's the hardest part to understand for people, because they're saying I sold something, but you had the revenue 2 lines before here. So here, this is the point I made the revenue, and this is the point I only get the money. So I don't make a revenue twice. Here I got my revenue. And the last part, Juan gets the electricity bill for 100 euros. Utilities payable went up 100 euros, and my equity went down, went also up with 100 euros. Does everyone agree? Yes. Last part, exactly. Juan pays an electricity bill. This is an expense. He bought electricity, neutrons, which he used immediately to get the shop up and running. He couldn't have done anything without electricity in the shop, so therefore this is an expense. And the cash withdrawal of 1,000. Peter in the back said, this is an expense.
Oh, no, it's a balance transaction. Did you say that if you do a party, right?
Yeah.
A
This is
private party, then it's not an expense. If it's
Yeah.
a company party, then it's expense, right?
And I said this is a private party,
Okay, so
not tax deductible.
Right.
So the only thing Juan did here was take out cash from the cash register, put it back in his own money, just as in the first line where he put 12,000 euros of his own money into the company. So this is only a transaction on the balance, not tax deductible, not a revenue, not an expense. He didn't trade in an asset or something like that to make a revenue. Okay, so therefore the last line is not part of this equation. And finally we have ends month, the same numbers over again, which sum up to 12,000 euros, 12,100 euros of equity. All these figures you can put into an income statement. So just before we had the balance sheet, and this is our second financial statement we have, our income statement. We have our sales of 4,000 euros. Remember, he sold some goods for 4,000 euros. The amount it took him to sell those goods was 2,200 euros, which gives him a gross margin of 1,800 euros. The gross margin is very important for you as a company, so you know if you have a good enough margin to get the other expenses paid, like the rent he had for 600 euros to open the shop, get it up and running, and the utilities expenses. Total operating expenses of 700 euros, which gives him, remember, net income, something minus something. This is his net income. This is the part in which he will pay his taxes over. So in this basic course, introductory, now you know everything about assets equals liabilities plus equity, and revenues equals expenses plus net income. Are there any questions?